Hey everyone, and if you own Apple stock right now, you're going to want to stick around for this one, because some major Wall Street analysts just hit the brakes on one of the most beloved stocks in the entire market. So here's what happened. Apple, the company behind pretty much every device in your pocket, on your wrist, and in your home, just got a downgrade from analysts over at Barron's, and they didn't just give one reason, they gave three. And honestly, when you dig into them, they paint a pretty interesting picture of where Apple is heading right now. Let's start with the first reason, and this one is really about valuation. Basically, Apple's stock price has been running hot. When analysts look at what a company is actually earning compared to what investors are paying for its shares, there's a metric called the price-to-earnings ratio, and right now, Apple's is sitting at a level that's pretty hard to justify. Think of it this way: you wouldn't pay $1 million for a house in a neighborhood where every other house is selling for $300,000. The fundamentals just don't line up. Analysts are essentially saying that the stock has gotten ahead of itself, and the current price already bakes in a lot of optimism that may or may not actually materialize. Now the second reason gets a little more specific, and this is where it gets really interesting. It's about iPhone sales, which is still Apple's bread and butter. Despite all the buzz around services and wearables, the iPhone still drives the massive chunk of Apple's revenue. And right now, there are genuine concerns about demand, particularly in China. China is an enormous market for Apple, and it's been facing some serious headwinds there. Competition from domestic brands like Huawei has been intensifying, and the Chinese government has reportedly been restricting the use of iPhones among state employees. That's not a small thing. When you're potentially losing ground in the world's largest smartphone market, that is a real problem for your growth story, and investors need to take that seriously. The third reason ties into something that a lot of Apple fans have been excited about, and that's artificial intelligence. Now you might be thinking, wait, isn't AI supposed to be a good thing for Apple? And yes, in theory, Apple Intelligence and their push into the AI space could be a massive growth driver down the road. But here's the thing: down the road is doing a lot of heavy lifting in that sentence. Analysts are pointing out that Apple's AI monetization timeline is still really unclear. We don't yet have a concrete picture of exactly how Apple turns its AI features into significant new revenue streams. And Wall Street hates uncertainty. Investors are already pricing in a rosy AI future for Apple, but the actual financial payoff from that bet could be much further away than the stock price currently suggests. So when you put all three of these together, an expensive valuation, softening iPhone demand especially in China, and AI ambitions that haven't translated into real dollars yet, you start to understand why analysts felt it was time to pump the brakes a little. Now, none of this means Apple is suddenly a bad company. Let's be clear about that. This is still one of the most profitable, most cash-rich businesses on the planet, with one of the most loyal customer bases in history. A downgrade isn't a death sentence, it's more like a yellow flag on the racetrack saying slow down, be cautious, let's see how things actually play out. But here's the question worth sitting with tonight: if even Apple, the gold standard of tech investing, is starting to show cracks in its growth story, what does that tell us about the broader expectations we've all been placing on big tech? Something to think about. Thanks for watching.